Have you ever looked at a stock chart, watched those prices bounce around, and just wondered, how do some traders seem to know exactly when to get in or out for those shorter term gains? Today, we're really going to try and cut through some of that noise. Our mission for this deep dive is to demystify what we call high quality setups in swing trading. Yeah, we're going to pull back the curtain on different swing trading strategies. And this isn't just about, spotting a pattern on a chart. It's more about understanding the intuition behind it. Like, why do these patterns even show up? How do things like market psychology shape them? And most importantly, how can you use this knowledge to spot opportunities?
Absolutely. And having that understanding, that framework is incredibly valuable. Once you grasp these sort of fundamental market archetypes, you can navigate things with much greater precision. Whether you're actively trading or just want to understand what's driving prices, these insights are, well, they're a shortcut to being genuinely informed. We'll dig into momentum, mean reversion, event-driven stuff, sector rotation, and even pairs trading. It's the essential toolkit.
Okay, let's unpack that. First stop, momentum swing trades. This idea of buying high to sell higher. It sounds almost counterintuitive, doesn't it? Like you're just chasing. What does that actually mean in practice? And how do traders find these without, getting caught right at the peak?
That's a great point because it does feel a bit wrong at first. But momentum swings are about identifying a stock that's already showing strong upward movement. It's got an established trend. You're essentially trying to ride the continuation of that trend. Think of it like jumping onto a moving train that's clearly going in one direction. Traders look for these powerful directional moves, often buying when a stock breaks out from a consolidation pattern. That breakout signals that pent-up buying pressure is finally taking over. It taps into that herd mentality.
Oh.
Strength attracts more buyers.
Right, so it's not just random chasing. There are specific signals. What kind of scans or tools point towards these potential momentum stocks? And what about those chart patterns you mentioned, the ones that confirm the energy?
Exactly. It's a mix of, let's say, quantitative scans and just visual pattern recognition. On the scanning side, traders use things like new highs and breakout scans. Pretty straightforward. They just filter for stocks hitting new price levels or breaking resistance. They also look for relative strength leaders, stocks that are outperforming the overall market. And checking market breadth helps see where the big money is flowing. But the real art, I think, is in reading those chart patterns. Price action tells a story. We look for continuation patterns like flags, ascending triangles, and the really classic one, the cup and handle.
Ah, the cup and handle. I've heard of that. Can you break that down? Like, what does it actually look like? And what's the intuition? Why does it form?
Yeah, it's a great one because it's so visual. Imagine, well, a coffee cup with a handle on the right side. The cup part is this rounded bottom that forms after an initial move up. It signifies a period where selling pressure is fading. You often see volume decrease towards the bottom of the cup that shows sellers are losing interest and buyers are slowly starting to absorb the shares available. It's building a base.
Okay, a base, like a foundation for the next move.
Precisely. It lets the stock sort of digest its previous gains. Then you get the handle. This is a smaller, tighter consolidation phase on the right side of the cup. It often slopes downwards slightly. This is like a final brief pullback. The last few weeks, sellers get shaken out and buyers really start to take control again, usually with even lower volatility. It's like coiling a spring tighter and tighter.
Coiling a spring, I like that analogy. So the pattern forms because the stock needs to rest and consolidate before moving higher.
Exactly. It needs to consolidate, absorb sellers, and reduce that volatility. It builds up potential energy. So traders watch these like a hawk. And when the price breaks decisively above the handle's resistance level, and this is key especially on high volume, that's the signal. That high volume confirms real buying interest, likely from institutions, saying, okay, this stock is ready to go.
That makes a lot of sense. The volume confirmation is crucial. But I guess not every pattern that looks like a cup and handle works out right. How do you tell a good one? One that's likely to explode from a weak one, or worse, a false breakout?
Yeah, that's the million-dollar question, isn't it?
Yeah.
Filtering the noise. A good setup has a few key characteristics. You want a well-defined, tight base. That diminishing volatility we talked about, the price action, should really squeeze before the breakout. The breakout itself needs to be powerful. An explosion is a good word for it. Should happen on heavy volume, significantly higher than average. And look at the closing price for that day. You want the stock to close strong, near its high, well above that old resistance level. That shows the buying pressure held throughout the day.
Okay, so a strong, close, heavy volume, tight base. What does a bad one look like? A false breakout.
A false breakout, or what experienced traders might call a no-count breakout, often looks like this. The price might poke above resistance during the day, maybe even briefly. But by the end of the day, it pulls back, closing back inside the old range, maybe leaving a long upper shadow or wick on the candlestick. And often the volume is just average or maybe even low. It just doesn't have that conviction.
Got it. So intraday spikes don't count unless they hold into the close with volume.
Exactly. And context matters hugely too. Is the overall market bullish? Is the sector strong? That increases your odds. And critically, avoid chasing late-stage breakouts. If a stock has already had multiple bases and is way extended, the risk is much higher.
Okay, that's momentum. Now, mean reversion. If momentum is riding the wave up, this sounds like betting on the opposite, right? Catching a bounce after a fall. Isn't that risky, like trying to catch a falling knife?
You nailed the core idea. And yes, the falling knife risk is exactly why you need strict rules and quality filters here. Mean reversion is basically betting against the recent extreme trend. The underlying idea is statistical. Prices tend to revert towards their average or mean over time. So you're buying after a sharp, extended decline anticipating a rebound, or conversely, shorting after a big, fast rally expecting a pullback. It's all about identifying situations where the price seems to have moved too far, too fast, usually driven by emotion, and betting on a snapback as things normalize.
So finding those overdone moves, what indicators help spot these potential bounces or pullbacks? How do we know it's stretched too far?
We look for clear signs of extreme conditions, often using technical indicators called oscillators. Tools like the Relative Strength Index, RSI, are really popular. RSI measures the speed and change of price movements. Generally, reading below 30 suggests a stock might be oversold, and above 70 suggests overbought.
Oversold and overbought. Okay.
Right. And there are others like stochastics or Williams-Broussard that work similarly, flagging extreme price levels relative to a recent range. Another big clue is looking at how far the price has deviated from its moving averages, or if it's touching or even outside the Bollinger Bands. Those bands are designed to contain most normal price actions, so touching or exceeding them signals an unusual stretch.
And the logic is that these extreme moves are often emotional reactions. Panic selling or maybe euphoria.
That's the psychological underpinning, yes.
Yeah.
Panic selling pushes a price way below its perceived value, or excessive greed pushes it way above. Eventually, some rationality returns or maybe just profit-taking kicks in, and the price snaps back towards its average.
I can definitely see the appeal, but yeah, that fear of buying something that just keeps dropping. How do we separate a good mean reversion setup, a temporary dip, from a stock that's genuinely broken a value trap or that falling knife?
That is absolutely crucial. A good mean reversion setup isn't just about how far something has fallen. You need to see signs of stabilization. Look for the sharp decline, yes, but then watch for price action starting to flatten out, maybe at a known support level. You might see a huge volume spike near the bottom that can be capitulation selling, where everyone gives up. Then, importantly, volatility often starts to contract as the selling pressure eases.
So wait for the selling to exhaust itself.
Exactly. And look for specific reversal candlestick patterns, like a hammer or a bullish engulfing pattern. These suggest buyers are starting to tentatively step back in. And here's a key distinction. Avoid those value traps or falling knives. A quality setup is usually a fundamentally solid company that's hit a temporary, maybe non-fundamental, speed bump, not a company whose business model is broken.
Right, the mean it's reverting to still needs to be relevant.
Precisely. If the company's long-term prospects have genuinely deteriorated, that old mean doesn't matter anymore. A bad earnings report for a good company might be an opportunity. A company heading for bankruptcy is just a falling knife. Oh, and context again. Mean reversion tends to work better in markets that are generally going sideways or oscillating, not in strong established trends. If the whole market is crashing, oversold can get a lot more oversold. Trying to pick bottoms then is really painful. Okay, wow. So momentum and mean reversion cover a lot of ground riding trends and fading extremes. But you mentioned other types of setups too. What else should we have in our swing trading awareness?
Right, there are three more key archetypes that add a lot of nuance. First up, event-driven swings. These trades revolve around specific, known catalysts. Think earnings reports, major news, FDA announcements, regulatory changes, things that can dramatically change a stock story quickly. For these, traders are glued to earnings calendars, news spanners setting up alerts for specific keywords like FDA approval or merger. They're looking for catalysts. And the idea is that the event forces a reevaluation of the stock's price.
Exactly. A significant event can fundamentally re-rate the company, often overnight. It attracts new institutional money and creates a whole new narrative. Now, a strong catalyst is usually as a prize, something the market didn't fully expect, and it materially impacts the company's future earnings or potential. This often leads to a big price jump on massive volume, with strong follow-through buying in the days after. Think of a small drug company getting a surprise approval.
And a weak one?
A weak one might be news that was already widely anticipated, or maybe the news sounds good, but doesn't actually change the fundamental picture much. You might get a quick pop, but then it often fades as people who bought in anticipation sell the news. The impact was already priced in.
Makes sense. Okay, what's next after event-driven?
Next is sector rotation and thematic swings. This is more of a top-down approach. It's about identifying which broad sectors of the economy or which investment themes are gaining strength relative to the overall market, and then shifting capital into those areas. We spot these shifts by looking at the relative strength of sectors. You can compare sector ETFs like the tech sector versus the S&P 500, for example. There are tools like relative rotation graphs that visually map this out, showing which sectors are leading, weakening, lagging, or improving.
So you're trying to catch the wave as money flows from one area to
Yeah,
another.
precisely. You also look at market breadth within the sector. Are lots of stocks participating? And you consider the macro picture. Where are we in the economic cycle? Are interest rates rising or falling? Different sectors tend to outperform in different environments. The intuition is just that markets move in cycles. Being proactive and positioning for the next leading theme can be very powerful. A good rotation setup is caught relatively early, shows broad participation within the sector, and has technical confirmation, like the main sector ETF breaking out of a base.
Okay, and the last one.
The last one is pairs, trading, and relative strength pair swings. This is a bit more sophisticated. It involves taking opposite positions in two related assets, simultaneously going long one and short the other. The goal here is to profit from the relative performance difference between the two, while hopefully neutralizing some of the overall market risk.
How do you find pairs?
You might use statistical tools to find historically correlated stocks that have temporarily diverged. Think two big companies in the same industry, like, say, Coke and Pepsi, or maybe two major banks. If their prices usually move together but suddenly split apart, you might bet on them converging again. That's a mean reversion pair trade. Or you could look at relative strength within a group, go long the strongest stock in a sector and short the weakest. That's more of a momentum pair trade. Sometimes news affects one company in a pair more than the other, creating an opportunity.
So you're betting on the relationship between the two stocks.
Exactly. For the mean reversion type, you need a strong historical correlation and evidence that the divergence is likely temporary, not some fundamental shift. For momentum pairs, you need evidence of persistent diverging strength. Often traders will chart the actual spread or ratio between the two stocks prices and look for extremes. It's about exploiting relative mispricings or performance trends.
Wow, okay. That's a fantastic overview of the different archetypes. It feels like even though they're distinct strategies, there must be some common threads, right? Some universal signs of a higher quality setup that apply across the board.
You're absolutely right. If we zoom out, there are definitely some universal filters that apply regardless of whether you're trading momentum, mean reversion, or anything else. Three things nearly always matter: liquidity, volume, and a basic quality check. First, liquidity and volume. This is non-negotiable. You need to be able to get in and out of the stock easily without your order significantly moving the price against you. That's called slippage.
Right, you don't want to trade something where there are hardly any buyers or sellers.
It's exactly. Illiquid stocks, even if the chart looks perfect, can have wide bid-ask spreads. They're easier to manipulate and just harder to trade cleanly. So always filter for sufficient average daily volume. Second, what I call a stability or basic quality filter. Even if you're primarily a technical trader, it pays to apply a loose screen for decent fundamentals. You're not doing deep dives into balance sheets, but you want to avoid obviously sketchy companies, penny stocks with no revenue, companies drowning in debt, things prone to sudden collapses or getting delisted. It's just about avoiding trading garbage, focusing on reasonably solid companies that happen to be in a good technical spot.
That's a really important point, adding a layer of fundamental common sense even to technical trading.
Okay, so on the flip side, what about avoiding those classic traps that seem to snag so many traders? We mentioned false breakouts and falling knives.
Yeah?
What else? Yes, avoiding the pitfalls is just as important as finding good setups. It really comes down to risk management. For false breakouts, like we discussed, the absolute key is waiting for confirmation. Don't jump the gun on an intraday poke above resistance. Wait for that strong close above the level, ideally on high volume. If it closes back in the range, especially with a long upper wick, walk away. That's a failed breakout. And always, always use stop losses placed logically below the breakout point or the base.
Okay, patience and stop losses for breakouts. What else?
Avoiding chasing extended moves or entering too late. That fear of missing out, or FOMO, is powerful but dangerous. If a stock has already gone vertical, way above its moving averages, the risk-reward is terrible. You're likely buying near a top. Focus on those earlier stage breakouts from proper bases. For catching a falling knife in mean reversion, again, wait for confirmation of a turn. Don't just buy because it's down 20%. Look for stabilization, maybe a reversal candle pattern, signs that momentum is slowing. Use stop losses below the recent low.
So patience is key for mean reversion too.
Definitely. And for pairs trading, you have to constantly monitor the reason for the pair. If the fundamental relationship between the two stocks changes, maybe one gets acquired, or a new competitor emerges that affects one more than the other, that's a correlation breakdown. Your original thesis is gone, and you need to exit the trade. And maybe the most universal point, always consider the general market context. A perfect setup in a bear market has much lower odds than the same setup in a bull market. Don't fight the overall tide too hard. It's like trying to swim against a strong current.
What a fantastic deep dive. We've really journeyed through the landscape of swing trading setups. From riding momentum waves to catching bounces, reacting to news, shifting between sectors, even balancing pairs. It seems it all boils down to recognizing what makes a setup high quality.
It really is. And by systematically understanding these indicators, the psychology behind patterns like that cup and handle, not just what they look like, but why they form and how traders actually use them, you build a much more robust mental framework. You move beyond just reacting to price blips. You start developing that discerning eye.
So, for you, our listener, what does all this mean? It means that the market, while it seems complex, actually communicates. It speaks a language through these patterns, through volume, through relative strength. Developing the ability to spot a tight, orderly base or recognize truly climactic volume, or tell the difference between real news and just noise, or understand why two stocks might pull back together, that gives you a real edge. It's about seeing the quality amidst the chaos. And for your own next deep dive, here's something to think about. Now that you have this richer understanding of these foundational setups, what new market behavior, what subtle pattern are you going to be most curious to watch for in the charts you look at tomorrow? Keep that curiosity going.